As you know, yields on federal government bonds have significantly increased during 2016. In fact, I think you had another 200 basis point hike on the monetary policy rate, all in a bid to quell inflation and so on and so forth. Now that obviously has, it's actually taking yields quite high. But more importantly also is the policy that is being pursued by the monetary authorities in terms of trying to manage the twin evils, which is the issue of exchange rate and interest rates. So one can argue that there's some partial flotation of the exchange rate. It's not a full flotation. And there's those who argue that that is part of the problems that we have actually created for ourselves. In other words, if we were going to float it, it will find its level, But in trying to protect the Naira, it appears that the monetary policies authorities have also embarked on a sort of continual mop-up, all right? Then you have TSA. So all this has basically led to it's like squeezing out Naira from the system, which has meant that because you then have no liquidity, all right, it's caused a sort of abnormal interest rate structure. So to my mind, having the federal government borrow at 20% or over 20% gross, risk-free, tax-free, I think is abnormal for a year. 1 year treasury bill is about that. I mean, it's pretty, abnormal. So we've gone into a very steep, not steep, but I wouldn't say steep, but negative, pretty negative curve, which is again, not the kind of curve you want for any company or any country that needs development. Let me put it that way. So that's been that, and of course, activities have dropped. Trading activities have dropped again because liquidity has dropped. Most pension funds are hitting, if not already hit, their buckets. All right. In other words, they're full on government debt. Okay, so that's reduced a lot of trade. So if you look at FMDQ and you look at the volumes on FMDQ, I think the third, fourth quarters there's a sort of dip. I mean, it's still high, but it's not like what you see, what you were seeing a year or 2 years, ago. So there's a lot of monetary policy impact that has impacted the government, sector, and that has obviously, had some impact on sub-sovereign. One is that, again, because you have a situation where revenues have reduced, you've had to have, in fact, this started a couple of years ago, caps on how much the state can borrow, so that's been reduced. You've had a lot of states restructure their debts because they couldn't even pay it. My view is that, if a state was looking to go to market today, there's some states that can. Lagos State, for instance, because of its own revenue generation. But states that are predominantly dependent, on FAC, for instance, will find it difficult, I think. Into corporates, corporates obviously suffered enormously. I think corporate debt has really been suffering since the decision to take a monetary policy of moving MPR from 6% to 12% and now 14%. It has made a lot of corporate debt unsustainable. And that, to me, is really the dilemma I sort of wrestle with, is the issue of how do you achieve development? How do you deflate the economy? How do you become productive? Because the whole issue that I hear from monetary policy, and this is going even to the past administration in terms of the CBN, is the issue of, the country is import dependent and therefore heavily reliant on foreign products. The exchange rate has a major impact on our economy. And my view has always been that I hear that. It's totally clear. I mean, look at when the Naira jumped, look at the inflationary effect it had. But the truth is, if the inflation that we have, all right, is because we're unproductive. Because the reason why we're buying or importing this glass, all right, or wherever it is because we're not producing it here. And the reason we're not producing it here is because it's expensive to produce here. We're just not competitive. Now, I ask myself a question. The only way you can break that cycle, all right, is that you have to, at least in terms of the factors of production, all right, you have to find a way to reduce it. And one of those key factors is cost of funds, significantly making cost of funds more economical would make power companies be able to probably do very long-term debt and hopefully make them a lot more productive. If we had borrowed $30 billion 2 years ago, and we followed the right path, we had done exactly what we've done over the last, 18 months or 1 year or so. By no fault of anybody, all right, the Ministry of Finance and the Federal Republic of Nigeria and all of us here would be owing about $60 or more billion straight up. You look puzzled. Why? You borrowed at a time when it was 197 or 165 or whatever it was, 167, so exactly. And now, whether you like it or not, it is about 400. Thank you. Overnight. Not your fault, not my fault. Boom. How do you pay that back? You tell me. Where would the Naira be in 2 years' time? Do you know? I don't. So from that perspective, there's a school of thought that says, do you want to go expose yourself to a $1,900 billion debt? Because that's what will happen. Because at the end of the day, right, you may say, oh, I'm generating dollars, but your GDP is in Naira. Okay? So whilst I understand, and I think the other school of thought is that, if we borrowed the $30 billion and we invested it heavily in X, B, C, D, E, okay, we can get the economy going, right? Maybe. But then it has to be prudently invested in, all right? And there's another school of thought that says, well, historically, we just haven't been pretty good at doing that. So $30 billion comes in, and maybe at best $10 billion is spent, all right, or 15, and a lot of it is frittered. Now you have a mountain of debt, you haven't achieved your goal, your currency is still depreciating. That's like a triple whammy. So, so the question is, why are we going to borrow offshore? We're going to borrow offshore because the interest rate is low. Okay? And this is where I always ask myself a question. The handshake that should normally occur between fiscal and monetary. Exactly. Because if you're saying that if we borrow $30 billion, right? Okay, offshore, blah, 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 right? We can do a lot. My question then is, how much borrowing capacity could you achieve domestically if your rates made all these projects economically viable? I don't think that interest rates is what is driving investors to come and invest in your country, in Nigeria. I don't think it is. If my rates were 9%, 8%, but I had a stable currency, investors will come. What is not allowing investors to come into the sector today is not because your MPR or your bonds are 20, 30%. I mean, if it was about interest rates, right, then countries that have those ridiculous rates will be getting foreign investors now regularly. Thank you. It's not about the rate. It's really about, right, the consistency, all right, of your currency. I know I can come in, I know I can go out, you know? And that's why there's another school of thought that says the reason why we found ourselves in this has been the policy somersaults, which has made investors just say, I don't know what they're doing, I'm holding on to my money. I mean, I hear from something I read from Obi Akwelesi that about $80 to $90 billion left the country in a very short space of time. Policy somersaults. I think if you had to look at it, if there was one thing that needed to be fixed to make 2017 a much better year, I think would be the issue of policy and thinking through policies, and once announced, we're sticking through it. I think also investors, both domestic and foreign, seeing a strong handshake between fiscal and monetary, all right, would also increase investor confidence. In other words, we're all on the same page. We're all doing the same thing, or we're fighting the same battle, and we're trying to fight it the same way. You can't be fighting from this angle, I'm fighting from that angle, all right, and you're more or less fighting as cross purposes. You know what I mean? So those are the kind of things that I think need to be addressed, if 2017 is going to bring any change. If not, I hate to be a predictor of doom, but I don't see anything but more of the same, quite frankly, if not worse.